Apple just launched the iPhone 17, but instead of excitement lifting the stock, it tumbled by over $100 billion in market value within days. Investors are asking, was the launch too overwhelming? Or is this just an overreaction by Wall Street? But the biggest question is this dip in Apple stock a golden buying opportunity? Or is a warning sign to stay away? The iPhone 17 launch was one of the most anticipated tech events of the year. Fans expected big leaps like sleek design changes, more AI features, and something more disruptive to push Apple ahead of its competitors. But when the reveal came, excitement quickly turned into disappointment for investors. So in this video, we'll explore once again why the Apple stocks dropped, what strengths does the company still hold, what risks remain, and most importantly, whether buying the dip makes more sense or staying away does. So let's get right into it. Right after the iPhone 17 launch event, Apple stocks fell sharply, around 3% in a single day, wiping out more than $100 billion in market value. For a company as massive as Apple, this kind of swing wasn't unheard of. But the timing
market
made it
reaction
clear
highlights a
that
broader
investors weren't impressed by the
Expectations
announcement.
for Apple are sky high, and when the company doesn't meet them, Wall Street can be quick to punish the stock. Incremental upgrades, not breakthroughs. The iPhone 17 offers upgrades, but investors say they're evolutionary rather than revolutionary. That left many feeling like Apple had played it safe, especially when rivals are pushing harder on innovation like foldable phones and AI. Disappointment in AI roadmap. Many expected Apple to showcase bold artificial intelligence features, but some were delayed or underwhelming. In a world where AI is the buzzword driving tech stocks, Apple's slower rollout raised doubts about whether it can compete with Microsoft, Google, or OpenAI-driven products. Margin pressure from tariffs. Apple is absorbing about $1 billion in tariffs without raising iPhone prices. This is good for customers, but a challenge for investors. It means Apple's profits could shrink even if sales remain solid.
Despite the sell-off, Apple still remains one of the strongest companies in the whole world. Delivery times for iPhone 17 pre-orders are tracking longer than last year, which often signals healthy demand. JP Morgan and other analysts have noted that this could hint at better than expected sales in coming months. Apple also isn't just a hardware company anymore. Its services business, spanning subscriptions, iCloud, music, and App Store continues to grow steadily. So even if hardware sales stumble, its services segment provides recurring revenue and helps smooth out short-term
When deciding
volatility.
whether to buy the dip or stay away, here are the most important signals to keep an eye on. Number 1. iPhone 17 sales trends. Watch for sales data in China, India, and the US. If the iPhone 17 sees strong adoption, it could quickly change market sentiment. Weak sales, on the other hand, may confirm investor fears. Number 2. Apple's AI roadmap. Pay attention to updates on Siri, machine learning, and device-level AI features. If Apple begins catching up with competitors, the stock could get a strong boost. Number 3. Profit margins. Apple is absorbing billions in tariffs and rising supply costs. Investors should track how much of this hits the bottom line when quarterly earnings come out. Number 4. Earnings guidance. Apple's outlook for the next quarter will reveal how confident management is in demand and margins. Strong guidance could stabilize the stock. Weak guidance may fuel more selling. Last but not the least, macroeconomic conditions. Interest rates, inflation, and consumer spending trends will all affect Apple's performance. Even the best iPhone can escape the reality of tighter wallets in a slowing economy.
So, is the dip a chance to buy Apple stock? Well, the answer depends on your risk tolerance and time horizon. If you are a long-term investor who believes in Apple's ecosystem, cash flows, and ability to innovate, Buying on weakness can be a smart move. Over the next 3 to 5 years, Apple is likely to remain a dominant player, and these short-term dips can turn into strong entry points. On the other hand, if you're more cautious, waiting could save you pain. The upcoming earnings report and real iPhone sales number could give much clearer signals. So if Apple disappoints again, you may get an even better price later. Personally, I see this more of a measured buy the dip moment because Apple's fundamentals remain strong and much of the sell-off seems to be due to disappointment over expectations not being met rather than any fundamental weakness. That said, I wouldn't go all in. A smarter move for me would be to take a partial position and keep some cash ready so you can buy more if it dips further or show sign of recovery. But that's about me. What are you going to do about it? Let me know in the comments down below and I'll see you very shortly in the next one.